In today's dynamic business landscape, we Aina Zulaika binti Muhammad Azhar, Aisyah Ilman binti Johari Amin, Wan Muhammad Ali bin Wan Nur Idwan, and I, Nur Shamimi binti Saifulizan from class DIB5A, would like to express our sincere gratitude and appreciation to all those who have contributed to the successful completion of our group assignment for the subject Business Finance FIN2603. First and foremost, we extend our heartfelt thanks to our esteemed lecturer, Yasmin binti Ishaq, for her invaluable guidance, support, and encouragement throughout the duration of this project. Yasmin's expertise in the field of finance, coupled with her dedication to teaching, that has been instrumental in shaping our understanding of complex financial concepts and theories. Her insightful feedback and constructive criticism has played a pivotal role in refining our work and pushing us to strive for excellence.
We would also like to acknowledge our fellow classmates for their collaboration, cooperation, and contribution to our group discussion and brainstorming session. The diversity of perspective and ideas brought forth by each member has enriched our collective learning and experience and enhanced the quality of our work. Additionally, we extend our gratitude to the authors of the textbook, research papers, and other academic resources that we consult during the course of our research. Their pioneering work has provided us with a solid foundation upon which to build our understanding of the subject matter and develop our insight. Last but not least, we wish to thank our friends and family members for their unwavering support, understanding, and encouragement throughout this academic journey. Their encouragement and belief in our abilities have served as a constant source of motivation and inspiration. In conclusion, we would like to express our deepest appreciation to everyone who has contributed directly or indirectly to the successful completion of our group assignment. It is through your collective effort and support that we have been able to achieve our goals and aspirations in the field of business finance.
Assalamualaikum warahmatullahi wabarakatuh. I, Aina Zulaika binti Muhammad Azhar, SIB 22110063 from the IB5A will be presenting the changes in its ratios based on historical and competitive analysis for Inohino Company. Firstly, historical analysis. Current ratio. The data shows an increase in the current ratio for Inohino from 2021 to 2022 with 1.9 times for 2021 and 2.12 times for 2022. Furthermore, the data indicates a decrease in the current ratio for Inohino from 2022 to 2023 with 2.12 times for 2022 and 1.8 times for 2023. First, increase from 2021 to 2022. The current ratio increased from 1.9 times to 2.12 times. This indicates that the ratio of current assets to current liabilities increased from 2021 to 2022, suggesting improved liquidity or the company's ability to meet its short-term obligation. Second, decrease from 2022 to 2023. The current ratio decreased from 2.12 times to 1.8 times. This suggests a decline in the ratio of current assets to current liabilities from 2022 to 2023, possibly indicating reduced liquidity or the company's ability to meet its short-term obligation. Next, quick ratio. The data indicates a steady decrease in the quick ratio for Inohino from 2021 to 2023 with 1.6 times for 2021, 1.4 times for 2022 and 1.2 times for 2023. First, decrease from 2021 to 2023. The quick ratio decreased from 1.6 times 2021, 1.4 times 2022 to 1.2 times 2023. A decrease in the quick ratio typically indicates worsening liquidity or difficulties in converting current assets into cash quickly. Inventory being deducted due to less liquidity. It might also indicate an economic downturn or shifts in industry dynamics. For the competitive analysis, firstly, current ratio. The data shows Inohino underperforms in 2021, 2022, and 2023 based on Inohino lower current ratio compares to the industry average. In 2021, Inohino current ratio is 1.9 times compares to the industry average, 2.19 times. In 2022, Inohino current ratio is 2.12 times compares to the industry average, 2.36 times. In 2023, Inohino current ratio is 1.8 times compared to the industry average, 2.23 times. Second, quick ratio. The data shows Hino quick ratio are same with the industry average in 2021 and 2022. In 2021, Hino quick ratio is 1.6 times, the same as the average industry, 1.6 times. In 2022, Hino quick ratio is 1.4 times, also the same as the industry average, 1.4 times. Based on 2021 and 2022, Hino quick ratio, Hino performed the same with the industry average both years. Meanwhile, in 2023, Hino quick ratio is 1.2 times, lower compared to the industry average at 1.9 times, making Hino underperform in this year.
Assalamualaikum and hi, my name is Aisha Ilman binti Joy Amin from class TIB 5A with ID number SIB 22110064. So today I'll be continuing with explaining what are the three implications based on current performance of the company. For current ratio, Hino ROT is not ideal, but Hino is able to meet short-term obligation. The implications are the company has flexibility for growth and investment. When liquidity ratios such as the current ratio are performing well, it provides the company with flexibility to pursue growth opportunities and strategic investments. With excess current assets available, the company can allocate resources towards expanding operations, investing in new projects, or acquiring assets without jeopardizing its ability to meet short-term obligations. This enhances the company's capacity for expansion and value creation in the long run. The next ratio is quick ratio. Hino ROT is not ideal, but Hino is able to meet short-term obligation. If the quick ratio of a company is able to meet short-term obligations, it suggests a healthy liquidity position. The implications are Hino has an efficient working capital management. A quick ratio that meets short-term obligations indicates that the company has sufficient liquid assets, excluding inventory, to cover its immediate liabilities. This suggests effective working capital management, where the company maintains an optimal balance between current assets and liabilities. It demonstrates the company's ability to convert its most liquid assets into cash quickly to meet short-term financial obligations without relying on inventory turnover.
Next is net working capital. Hino has a positive net working capital because their current assets are greater than their current liabilities, assuming Hino current ratio and quick ratio are greater than 1. Due to the positive net working, Hino has a strong liquidity position. Positive net working capital indicate that the company has a sufficient liquid assets to cover its short-term obligations. When liquidity ratio, such as the current ratio and quick ratio, are performing well alongside positive net working capital, it reinforces the company's strong liquidity position. This implies that the company can meet its immediate financial obligation without relying heavily on external financing or asset sales.
Now, we'll be moving on to the analysis for the assets management ratios for Samsung Electronics Company. The first one, inventory turnover. Samsung Electronics Company during year 2023 had a lower inventory turnover, which is 3.5 times compared to year 2022, which is 3.64 times and has higher ratio. The second one, average collection period, or called as SCP. Samsung Electronics Company during year 2023 take longer time to collect debt, which is 51 days, than year 2022, which is only has 43 days. This is not a good sign for Samsung. And the third one, non-current asset turnover. Samsung Electronics Company during year 2022 has higher non-current assets turnover, which is around 1.31 times compared to year 2023, which is only 1 times. This means during year 2022, Samsung is more efficient in managing non-current assets turnover. And the last one, total asset turnover. Samsung Electronics Company has higher total assets turnover during year 2022, which is 0.7 times, compared to year 2023, which only has 0.57 times. This means during year 2022, Samsung are more efficient in managing total assets turnover than in year 2023. The next one is the optimal course of action for Samsung Company. The sudden decrease in inventory turnover, which from 3.64 times to 3.5 times, need to be considered. Due to that, Samsung should prioritize optimizing its inventory turnover as it directly impacts cash flow and profitability. A lower turnover ratio indicates lower sales relative to the amount of inventory held, which ties up capital and increases carrying costs. By streamlining supply chains, implementing just-in-time inventory systems, and leveraging data analytics for demand forecasting, Samsung can reduce excess inventory levels and improve turnover. This not only frees up cash but also minimizes the risk of obsolete inventory and improves responsiveness to changing market demands. During year 2022, Samsung only took 43 days to collect debt, but during year 2023, days to collect debt suddenly increased to 51 days. A longer average collection period suggests inefficiencies in credit management and collection process. Samsung should review its credit policies to ensure they strike a balance between attracting customers and mitigating credit risk. Tightening credit terms, conducting credit assessments more rigorously, and offering incentives early for payments can help shorten the collection period. Additionally, improving invoicing accuracy and timeliness, as well as implementing automated collection reminders, can expedite cash inflows and enhance liquidity.
Non-current asset turnover was well managed during year 2022, but during year 2023, the management of non-current asset has lower efficiency. Efficient management of non-current asset is crucial for maximizing return on investment and maintaining competitiveness. A decline in the turnover ratio for non-current asset indicates potential underutilization or inefficiencies in asset deployment. Samsung should conduct a thorough review of its asset portfolio to identify opportunities for rationalization or reallocation. This may involve divesting underperforming assets, upgrading outdated equipment, or relocating resources to projects with higher return. By optimizing asset utilization and aligning investment decisions with strategic objectives, Samsung can improve overall operational efficiency and profitability. The decrease in total asset turnover, which from 0.7 times during year 2022 to 0.56 times during year 2023, show that Samsung is less efficient in managing total asset turnover in year 2023. The total asset turnover ratio reflects how efficiently Samsung utilizes its asset to generate revenue. A decrease in this ratio suggests reduced productivity or suboptimal utilization of resources. Samsung should analyze the drivers behind this decline, such as changes in production processes, shift in market demand, or inefficiencies in resource allocation. By identifying and addressing bottlenecks, optimizing production workflows, and investing in technology that enhance asset productivity, Samsung can improve its overall efficiency and competitiveness in the market. For question 3.1, explain the significance of debt and profitability ratios in financial analysis. In financial analysis, the significant debt and profitability ratios are crucial in financial analysis as they provide insight into a company's financial health and performance. Debt ratios like debt to equity and debt to asset ratios indicate how much a company relies on borrowed funds. This ratio provide insight the company's leverage level that may signal financial risk and its ability to manage debt obligation. For instance, a high debt equity ratio may signal that the company relies heavily on debt financing, potentially increasing its financial risk and vulnerability to economic downturn. Profitability ratios such as return on asset and return on equity measure how effectively a company generates profit from its resources. They reflect the company's ability to generate return for its investors and stakeholders. A high return of equity indicates efficient utilization of equity capital to generate return for shareholders, while a healthy gross profit margin reflects the company's ability to generate profit. Together, these ratios help investors, creditors, and analysts assess a company's risk, stability, and potential for growth.
Overall, these ratios serve as valuable tools for investors and creditors to make informed decisions about investing in or extending credit to a company. Based on its financial health and performance, ratios in finance serve as indispensable tools for both investors and creditors, offering valuable insight into a company's financial health and performance. Liquidity ratios such as the current ratio and quick ratio are characterized to assess a company's ability to meet short-term obligations. High liquidity ratio provide assurance to both investors and creditors, indicating the company holds sufficient liquid assets to cover its near-term liabilities. Investors use that ratio to assess a company's reliance on borrowed funds, which could indicate financial risk. Additionally, they analyze profitability ratios to evaluate how effectively the company generates returns on its investment, seeking strong returns. Creditors, on the other hand, utilize debt ratio to evaluate the company's ability to repay debts, preferring lower debt levels and higher equity to mitigate default risk. They also consider profitability, ratio to assess the company's capacity to generate sufficient cash flow for debt repayment, reducing their risk exposure. In essence, this ratio informs both investor and creditor about a company's financial stability, risk profile, growth potential, enabling informed decision-making regarding investment and credit extension based on comprehensive assessment of a company's financial health and performance.